right, welcome everyone to Withdrawal Investing Insights. Thanks for popping in today. We appreciate your time. Hope you learned something. We're going to do some Research 101 series on exchange traded funds and how to do some basic research on those when you're trying to look at what investments to look at. And we're going to use probably my favorite free website to get some good research, which is Morningstar.com. So we got Google loaded up. We're going to go over to Morningstar. Kind of check out. It might be a little daunting at first with all this data, but we're going to jump right into the quotes up here and get some information on probably the most utilized ETF, or one of the largest. It is the first exchange traded fund of all time by State Street, the SPY, which is the S&P 500 ETF. And we're going to just sort of dive in on all of these areas. We're going to cover the quote, the chart, fund analysis, performance, sustainability, risk, price, portfolio, people, parent, etc. Just to give you some good talking points to understand what you're looking at and what to look for when evaluating exchange traded funds for investment. So why would you want to buy an exchange-traded fund to kind of start before we get going? Well, they're typically baskets of securities, or they are baskets of securities, stocks, bonds, or a combination therein. Could even be alternatives. And it's a way of diversifying your portfolio pretty easily. There are some benefits of ETFs versus mutual funds. They trade throughout the entire trading day from 9:30 Eastern in the U.S. to 4 p.m., which mutual funds only trade at the end of the day. B, there's some tax benefits on owning ETFs, because if you own them, you don't realize any capital gains from capital gain distributions, which can happen in mutual funds and ETFs until you sell them. So that's a unique tax benefit for those investing in taxable accounts. And C, ETFs tend to have lower costs. Not in all instances, but they tend to have lower costs because you don't necessarily have a fund manager that's actively selecting the securities. So in this case, our expense ratio is 0.095%, also known as 9.5 basis points, which is very cheap in relation to most active funds. So some benefits of ETFs. So let's kind of dive in. So up here we have the name of the ETF, Spider S&P 500 ETF Trust. SPY is the ticker. And again, so we're not doing any subscription here, so this is just a free service that you can use. Then there's a star ranking, which Morningstar provides, and it updates, I believe, on a monthly basis. Generally speaking, it looks at longer-term returns and risk or Sharpe ratios for products. I will say you should take the star ratings with sort of a grain of salt. Oftentimes, they're not the best predictors of future performance, but are on more past performance. And oftentimes, the best stars might be the worst stars on a go-forward basis and vice versa. So you definitely want to take that with a large grain of salt. Here's a chart on kind of historical performance over the last day. You have the existing price, how much it's up. So we had a good day there on Friday, up 1.56%. Intraday indicative value. So this is actually sort of the IV, or what the underlying basket of securities is trading for, which can sometimes be over or below the price, which means that it would be at a premium or discount, which can happen sometimes when the markets are fragmented. Think of March of 2020. A lot of the bond ETFs were actually trading below indicative value or fair market value, and there were some opportunities there just because everyone was running for the exits. So NAV is net asset value of the fund. Again, that's similar to the IV on kind of what that fund is worth when the regulators are evaluating what each share is worth. Open price is what the ETF was at 9:30 a.m. in the previous morning. Bid ask is, when you're buying or selling, there's a spread that you have to pay the market makers in order to deliver you those shares. This shows the spread and how much it is as a cost. So in this very liquid product, it's 0.05%. You need to be wary of spreads for more illiquid ETFs and smaller ETFs. They could be larger, and it's sort of a hidden cost beyond the expense ratio, which in this one is also cheap. Volume shows, the volume of trade of ETF shares traded daily in the average. So Friday was a little bit higher than the average on the range. The day range shows where the ETFs is trading on that one particular day. So it was about a 7-point range from 433.83 to 440.93, ended near the top of that range. The year range is the 52-week range. So this often can give you insight on where it's trading in the past year. Whether you're a valuation investor, which typically you want to buy things lower, or a momentum investor, maybe you're buying mid or on the higher of the range, it gives you a perspective for, on a relative price basis only, what it's trading for. Here's the SEC SEC yield. So this is a dividend yield on kind of expected dividend. You can go in here. It's based on a 30-day period ending in the last day of the previous month. It's computed by dividing net interest income. I won't bore you with the details. You can read it. But it's basically a smaller sample size on what the yield is on the SEC yield, where the 12-month yield is a 12-month interest and dividend payment. So it's a longer horizon yield that accompanies more actual historical data. This one's probably going to be more realistic on a go-forward basis. Although if there's dividend adjustments in near terms, this can pick that up faster on the SEC yield. Here's the adjusted expense ratio. The adjusted expense ratio excludes certain variable investment-related expenses, such as interest from borrowings and dividends and borrowed securities, allowing more consistent cost comparisons across investments. Again, expense ratio, generally the lower the better. This one's very affordable. Total assets in the ETF, so $414 billion, pretty large ETF, one of the largest. And then the category, which is important on the portfolio comparison side, it's what we're comparing this ETF to. In this case, it's the U.S. large blend category, which is generally the S&P 500. Here's some more stuff that's more, to pay for, which we're not signing up. There's typically some things you can read, again, not signing up for that. Here's an important kind of long-term growth of the fund and the ETF here. It shows kind of going back over the last 10 years, 2013 to year to date, the growth of this product versus the index. As you can see, it's actually better than the index. Now, you might say, hey, how can this be better than the index if it is the index? Well, generally speaking, a very low-cost index is a benefit, and this can show that the managers can actually add some value to the index itself, even with the costs, through maintaining low bid-ask spreads on trading, among other things. So here's the category. So if you just own kind of a generic large cap blend, as we looked up over here, category, this is the average. So this shows that the average large cap blend actually underperforms the index, which kind of is a hit against active managers. Doesn't happen all the time, but on average, they generally underperform. And then this chart is kind of a general over and underperformance over time versus the index, or I'm sorry, not the index, the large cap blend category. This is the price, investment price here, and what that's done. This is the NAV. So there is that delta between NAV and price from time to time, especially when there's disjointed markets and there's mass selling. This shows the category NAV, which is the U.S. large cap blend. Generally speaking, example for the 23 year to date, the index beat the category by a healthy margin, about 4%. And then this is the index price return. So generally speaking, when you're looking at entire portfolio returns, you're including total return, which is price and reinvested dividend. If you strip out the reinvested dividend, this is just the price. It's important to know that reinvested dividends add for at least the S&P 500 long term, it's about 50% of the total return of the index is this measly reinvested, what is it, the 1.47, 1.56 yield. So that adds up because of that reinvesting to a pretty sizable chunk over time. So that's relatively important. I would generally recommend you reinvest dividends where possible. Here's the quartile rank. So it breaks it out into kind of 4 segments on a year-by-year basis compared to what this fund does compared to the category. So this year to date, it's in the top quartile. It's outperforming a good amount. Like last year, for instance, it actually did a little bit worse than the category at 1696. It was in the 3rd out of the 4th quartile. So the higher is the better. This is the percentile. So it even kind of goes in more detail on 1 being the highest percentile of the category of, in this case, there's 1,356 products that Morningstar covers in this large blend category. SPY was the 24th best, so pretty darn good. So you could see, or 24th percentile. So overall, it's been generally above the 50th percentile other than 2 years, 2013 and 2022. Higher percentile, the better, just like the higher quartile, the better. And then obviously the category hasn't changed. LB is for large blend, which you can hover over. So down here's the portfolio holdings for SPY. Kind of gives you the portfolio date. So this is another benefit of ETFs. There's transparency in index ETFs on what you own on a daily basis. Pretty attractive. Here's some names that you're obviously going to know: Apple, Microsoft, Amazon, in their weighting schema, or how much is owned as a percentage of the portfolio. You might notice that Apple and Microsoft and Amazon are, for 17% of the total portfolio. So this is called capitalization weighting, which is in a lot of indices. So you actually own a higher weighting of the security based on how big it is. So the bigger it is, the more you own of it. And that's kind of one construct to investing. And then this is the market value that the ETF owns in each, and then what sector each of these areas in. As you can see, we're kind of loaded up on tech and communication services for the top holdings in SPY. This breaks down kind of high level on what the strategy does. And then there's just kind of more generic info. One other thing here, equity holdings. So this helps to know how diversified the product is. In this case, S&P 500, we have 503 holdings. The one other holding here is probably cash. And then it shows you how top heavy or what weighting is in the top 10. So this is a higher, more top heavy portfolio, meaning the top names are a larger percentage of the portfolio and can affect performance from a higher amount. All right, so this is kind of the snapshot of the front page for the quote. Next, we're going to move over to the chart area. So I don't really use this a ton, but generally speaking, if you want to kind of dial down to different areas of how this product is doing, you can plug different time frames in. You can also compare other products. So let's just compare it in this case to RSP, which is the equal weight S&P 500 for comparison's sake. So not perfect because this actually doesn't have a matching time horizon and it doesn't automatically adjust it. But if we go to the 5 years, here's a comparison, the red line on RSP versus SPY, which is a capitalization weighted indice of the same things. You can kind of get a little more granular on, start dates and end dates if you want, but pretty straightforward chart. Here you kind of have volume on a regular basis going back on time if you want to look at it. So I don't really go into the charting too much, but it can definitely help you get some information and do some comparisons across funds. Again, totally free. Into the fund analysis, this is primarily more for paid subscribers. So you can have some things that you can read and find out more about the fund analysis. Let me go ahead and take a step back there, but not really an area I spent a ton of time on, so we'll skip over that quickly. Then we're going into performance. Again, very, very similar to what we saw on the cover page. You don't really need to kind of dig into that too much up here. But then down here, there's differentiated periods where you can go into how this product is returned. So this is more of a cumulative annualized since inception. You can look at 1 day, 1 week, 1 month, year to date, 1 year, 3 year, 5 year, 10 year, 15 year, the total return, and then also give you that category NAV. So rather than a year by year breakdown, you can sort of roll it up, as well as the index NAV, quartile, percentile, and then how it did amongst the number in the category. So obviously the higher the better on that. And you can kind of edit this a little bit based on if you want to look at the most latest data, the previous month's end, or the quarter end. So again, nothing too different here. You can also do some distribution data, which is useful if you have a higher yielding thing or you're really focusing on the income. You can see historically what the income has been in distributions. So, as September 15th, SPY paid $1.58 in income. June 16th, it paid $1.63. So, it's on basically a 3-month dividend schedule, and you can kind of figure out what that is. And then is there consistency to the income on the annual distribution? So that's helpful. Into sustainability. So sustainability is an ESG or an environmental, social, and governance score. And Morningstar gives that rating on sustainability rating. So the higher the sustainability rating, kind of the more ESG friendly it is. So for those that want to invest with an environmental conscious, this is one way to do that. 3-star out of 5 is decent, but obviously, kind of the lower risk here on the left means better ESG scores, and kind of you want to go more on the left for that ratio. And then it kind of gives you a sustainability summary, which is free, which is nice, that you can read and kind of evaluate for ESG investors. Definitely a newer thing, an investment, but something to know. This goes into the carbon footprint. So obviously we want the lower the better on the carbon footprint, and then kind of product involvement based on what you own. If you want to be more specific on, hey, I want to not look at animal testing or life ethics, and you can really dig in on that. Finishing up ESG, when you get into the product involvement, you can really focus on what ESG factor you're looking for and read on that. Super helpful for that. Next, we're going to move on to risk characteristics. So this is definitely a good chart when you're evaluating risk for a certain security. So here's kind of the Morningstar risk return. It's an assessment of the variations in investments' monthly returns, comparison to similar investments, greater the variation, the larger the risk score. Morningstar return is assessment of the investment's excess return over the risk-free rate, the return on the 90-day bill in comparison to similar investments. So definitely speaking, you want kind of high return and lower risk on these. S&P 500 is average and a little bit higher return, which is good. Here's volatility measures, so important things to look at. Alpha. So alpha is generally speaking kind of the return over the benchmark. So in this case, because you are the benchmark, you're not really going to get alpha. Indices aren't designed to get alpha. It's more to track the bench. Beta is sort of your volatility expectation. With a 1, meaning you are tracking the benchmark, in this case the S&P 500, and a 0 would be kind of very, very low risk, and a higher beta means higher risk. So 1 really just means you're tracking the bench, which this investment's specifically designed to do. R squared is kind of the fit of the model or expectation, the likelihood that kind of historical data will happen again in the future. In this case, we're right at 100 because we're not taking any sort of active risk or venturing from the benchmark. Sharpe ratio is sort of risk-adjusted return. So, how much is your return you're getting for the risk you're taking? The higher the Sharpe ratio, the better. So this is positive, which is a good sign, but the higher it is, the better. And then standard deviation, going back to the bell curve, is sort of what you can expect your sort of bouncing principle to be. The higher the standard deviation, again, the higher the risk, and the lower vice versa. And generally speaking, what this says is kind of in a 2 standard deviation environment, which generally speaking is 90 to 95% of outcomes, you can expect 2x this, so about, call it 34% up or down return. So generally speaking, 90 to 95% of outcomes will be between negative 34 and positive 34% with this investment. And you can see it's very in close line to the bench. Now we're going to volatility measures. This is upside and downside capture. So how this security is performing compared to the bench. Generally speaking, so 100 means it's right on line, which is you're the bench. For more active funds, which we're going to talk about in mutual funds at a later date, you want higher upside and less downside. Ideally, a 110, 90 is a great ratio for an all equity portfolio. And then this sort of shows you the standard deviation and return profile for a product. You want to be in the upper left quartile, which means less risk, more return. Upper right means more return, but more risk. And then kind of below the line is just generally suboptimal. These are drawdown components. So kind of what's your maximum drawdown for the investment over the horizon, which I think this is a 3-year horizon. And then kind of what it was versus the index. So again, that 23% drawdown. So there are times S&P can kind of take a beating down 23, and we've seen that. In this case, we're looking at the drawdown peak date when the valley was. So it kind of was doing better on the index January 1st of 22. It fell by September 30th, and the drawdown duration was 9 months until it recovered. So just be sure what this is. Downside capture ratio measures the manager's performance in down markets relative to the index. Yeah, we kind of went over that. Nothing new. So again, super important parameters. This is kind of looking at different horizons. So you can see when you change the data, like the 10-year standard deviation is actually lower than 3-year. Betas are still the same. R squared is still the same. Sharpe's actually a little better. So you can kind of compare this over different durations. Going on to the price. So this kind of shows cost of the product and the ongoing fee level. So prospectus net expense ratio. This is 9.5 basis points or 0.95% as of the certain date. This is a cost illustration, assuming you invest $10,000, get a 5% return over different horizons. So in this case, you're spending $10 per year on every $10,000. The estimated 10-year cost is $121. Again, pretty low. This is the anticipated kind of tax cost ratio. For the fund and capital gains exposure, it's negative, meaning it's pretty darn good because of that ETF benefit I mentioned earlier, but something you definitely want to look at from a tax standpoint. In other fees, you can have 12B1 fees and other things that happen in mutual funds that we'll cover at a later time. But again, super affordable fund in this case, and it gives you a horizon on what you're actually paying per $10,000 of investment over the long run. All right. Onto the portfolio. So this gives you an idea of what asset class you're investing in. Is it U.S. stocks, non-U.S. stocks, or international, fixed income or bonds? Is it other, cash, or non-classified? This is pretty much on the investment all U.S. stocks and a little bit of cash. and a very small amount of non-U.S. equity. So you pretty much know what you're getting. This is the category. So the large blend category, obviously they're still predominantly U.S. equity. Some own a little international. Some own a little fixed income. Generally, it's a little bit more cash. And then it kind of shows you what the index is. So the investment in the index in this case is really the same thing. This shows where we're at in the style box, right? So this is large cap companies, medium companies, and small companies in the style box. Value companies, blend, or growth. We are kind of in the large cap core space, which would be the upper middle versus mid cap core, small core. But this is tilting a little more toward growth because we've seen those communication service and technology companies really owning a larger percentage of the portfolio because they're bigger. So you can sort of expect this to be more of a large blend, large growth portfolio based on where we're at in the style box. It's an important thing to look at. So there's the map. Here's kind of the weighting on what you own in the style box. Again, the map kind of shows, but we're a little more large growth heavy. Then we got blend and value, and there's a little bit in the kind of the mid-cap space, tilting actually a little more toward core, mid-core or blend and mid-value, and then zero and small cap. And then this kind of gives you an idea of how the fund was historically in kind of large blend. Not surprising because it's an index, it's not going to stray. But in active funds, you could definitely have managers go to different segments of the style box based on their intuition and what they're looking at. So something to look at as you're evaluating securities. Here's a factor profile. So for those that know factors, they're academically theorized ways that enhance return and or lower risk over the long run. And we have the style, which this is kind of a growth style, tilt versus value. So it's the growth value dichotomy, kind of high yield versus low yield on the dividend side. Then you have momentum, which is technically 12-month minus 1 month price return on what it is. Quality, which is more consistent earnings and revenues better than less. Low volatility or volatility, lower is generally better than higher volatility. Liquidity, so liquidity, you want higher liquidity versus low liquidity. And then size, large versus small. Small actually tends to outweigh large over the long run. And this kind of shows you where this lines up. So from a tilt standpoint, growth value is really a personal preference on philosophy. Higher yielding is generally better than lower yielding unless you're worried about taxes. Higher momentum is better than lower momentum. Higher quality is better than lower quality. Lower volatility is better than higher volatility. Higher liquidity is better than lower liquidity, and low size is actually better than high size, generally speaking. And then you can look at this over different horizons. Here's an important consideration when you're kind of digging into the details on what this investment fundamentals say. So what's its price over earnings or price earnings ratio? Generally, the lower the better. It's pretty much in line with kind of the index because it is the index. And then there's the category average. Price to book, another valuation measure, lower the better. Price to sales, another valuation measure, lower the better. Price to cash flow, also lower the better. Generally speaking, over the average, it's actually a little bit better valuation or a little bit lower valuation, cheaper than the category average if you were to buy an average large cap blend fund. Here's the dividend yield, same deal. Long-term earnings growth, same deal. Historical earnings growth, sales growth or top line revenue growth and what it's done historically, that cash flow growth per annum, and then the book value growth per annum. So all relative things. You want these growth numbers to be higher as opposed to lower. And then going to the market cap, this gives you a perspective on the average size of the company that you own versus the category. So the category average size on market capitalization or how big a company is actually quite a bit bigger than what we have just in the index. And then here's the index average market cap. So we are a little bit higher than the generic index. These are kind of the percent in giant companies, which are the huge companies with very large capitalizations, large cap, mid cap, small cap, and micro cap. So obviously this being a large cap fund, there's pretty much no small or micro, predominantly large, giant, and mid. Here is the sector breakdown as far as what the investment owns in each of the relative sectors. So basic materials, consumer cyclicals on the way down versus the category average. Important to know to determine if you're kind of taking any big bets on what the sectors are. Here's the regional breakdown: North America, UK, Europe, Australia, Japan, etc. Again, US products, so all in there. And then the country breakdown, US product, all there to see where that's at. This is probably a subscription-only service. So you got to pay to kind of get that part on financial metrics. And then over here, again, going back to the equity holdings, what percentage it is, what your top 10 holdings and what percentage of the total portfolio is. In this case, it's 32%. What's the turnover of the fund? So how much are they buying and selling in the fund to eliminate or add securities, which is generally higher in active strategies, probably 20 to 50%, sometimes even higher. In an index-based strategy, it's very low. This gives you a good idea on sort of diversity as far as percent women directors of the companies and women executives. Generally speaking, diversity in companies adds value, and it promotes accountability, and it's good corporate governance. And this is kind of similar to what we saw here, but it gives you a little bit more detail without kind of the premium info on ESG ratings if you want to look at that more specifically, the sector breakdown. So obviously the higher sort of stars here or globes here on ESG, the better. And then this shows you kind of 1 year historical returns, so you can see what's done really well in the portfolio and what their PE ratio is, or forward PE, which is future PE. So some of these PEs are actually quite a bit high. It's something that I'm a little leery of in the portfolio, but something to know. And then you can kind of go on down the list to see other securities beyond just the top 10. So that's the portfolio piece. Super important aspect when doing research for this Research 101 piece on exchange traded funds. Now we're going to go to people. So it talks about when the fund was incepted. Again, the oldest ETF around, incepted in 93. There's one manager because it's a rules-based index. Longest tenure, so this manager's been around 30 years. It's PDR Services. Typically when you aren't dealing with an index, but you have an active manager, they show the management team and the breakdown and the history of the management team and what it's done. In this case, it's not super relevant. And sometimes there will be some proxy voting information for those that want to vote for ownership of the products. Generally speaking, it only happens in individual funds individual stocks as opposed to the fund base. So here's a parent analysis. So this kind of breaks down the parent company that owns this exchange traded fund. So as mentioned before, it's State Street. They're out of Boston. This is their US ETF market. They have $1 trillion with a T of assets, which is a lot. So you can kind of see the health of this company. Hey, should I be putting money in a company that's small, or, are they getting investment flows in versus out? In is obviously better. What their asset growth is on the trailing 12 months. So they've been growing. How many underlying products they own? 138, quite a bit. And their manager retention rate. So is there a lot of turnover in the managers, or are they having more stability? 93% retention rate's pretty good. This shows kind of the growth of their assets over time with the red line that's been up. Obviously, on kind of quarterly basis, these are each bar charts a quarter. You're going to have volatility in and out on flows. But overall, their flows, in this case, 13 billion, 34. In 2015, they lost some money. But since 2015, there's only been 1 year they've had negative flows in the billions of dollars. This shows kind of the total assets. You can see, in trillions, they were, 390 billion. Now they're over $1 trillion, quite a bit of growth over the last decade. Their growth rate, which is generally positive, it's a good sign. The market share of the industry, they're kind of hovering between 15 and 23%. They've actually came down. So they were 23% of the ETF industry. Now they're just 15, but still a pretty good size. And then number of investments in the ETF category, they've grown State Street from 125 to 142. So again, that's a positive sign. Going down here, this shows kind of their medalist rating and what they own, and the breakdown and how many gold funds they have, trailing 12-month inflows. Again, this is more of a paid subscription service I don't really use, but you can utilize that on the parent. So again, wrapping up, Research 101 series on exchange traded funds, really doing a deep dive on free research available to anyone that you really should be looking at when you're choosing what products to invest in. Join us next time at Withdrawal Investing Insights. We'll cover mutual funds, and then I'll do another piece on individual stock research on Morningstar as well that can be very useful. Again, this is not financial advice. You have to, do your own research, talk to a financial professional. We're just here providing tools and insights for you to understand these things that can seem more complicated a little better. Thank you for watching. Again, Withdrawal Investing Insights, signing off.